going to talk about the issue of fundraising and what you need to do as businesses to attract money that you need to expand your businesses. So if you want to know more about GFA Consulting, please consult my company website, gfa-consulting.com. And let's start directly with the challenges that many businesses face when they need to access funding. So I'm sure you're all familiar with that. Financial resources are extremely complicated to get, especially in Ghana now. But don't worry, it's the same in West Africa, Central Africa, everywhere. The cost of resources, of financial resources, is way larger than what you could find in other countries. Here in dollars, we're talking about, what, between 11 and 13% on the dollar. If you're lucky in Côte d'Ivoire, you have it at 8%. Nigeria will be more like 19% in dollars. Cameroon, same thing, 12%, same thing like as South Africa. So it's difficult when you have already challenging environments in your own country to get enough cash flows to pay back loans at 11, 12, 13% and still make a profit. Smaller businesses are perceived as riskier than larger firms, even though it's not necessarily the case, right? Private equity funds, these institutional investors, they don't have necessarily the resources to focus on smaller deals, and I'm talking about companies that are looking to raise less than $1 million. This is small, and very few institutional investors will venture into that space. So it makes the whole process even more difficult. Not working? Ah, okay. Banks don't necessarily know how to assess SME risk. I'm really sorry for the bankers. Okay. Banks, I'm sorry for all the banks in the room, but I believe that when it comes to assessing SME risk, there's still a lot of work to do to make it easier to distinguish between those that make sense and those that don't. Microfinance are too small. They cannot expand. They cannot fund expansion. So, you know, a company that needs $1 million, $1.5 million to expand its operation cannot find any solution with microfinance institution. And we don't have enough business angels. We have enough people with money, but they don't necessarily invest in productive companies. And I believe this is a major limit of African markets when it comes to access to funding. And finally, businesses themselves don't know how to sell their business in a proper way. So the idea of this session is really to help you, companies, whether you're large or not, by the way, understand the mindsets of those with the money and understand what you need to do to increase your chances of attracting funding. So before you engage into a fundraising process, I'm going to tell you what not to do first. Think that don't raise money just because you need it now, because the process doesn't depend on you. It's not because you're in a hurry that the investor will be. It's rather the contrary. They will take the time, and that time is usually in months. So a quick process with a private equity investor is 6 months, and that's quick. Normally, 9 to 12 months is more like the normal duration for a process. So you better plan for it. So as I said, it's not going to be less than 3 months. It doesn't exist. If somebody tells you that, I mean, I don't know how they make it, but I've never seen anything like this. Not with private equity funds, not with banks either. So another advice, don't leave the fundraising process to consultants. I am a consultant myself, but I believe that this is a process that you need to own. Because in the end, you are the one looking for the money, and you are the one who is supposed to be believed by investors, not the consultant. And don't forget, investors don't invest in a booklet, in a business plan, in a document. They invest in people, they invest in processes, they invest in governance, we talked about that, and then they also invest in the projects for which you want to raise funding.